Hello and welcome to the Business Standard Morning Show. My name is Ishan Gera and here are the stories for the day. The annual economic survey released on Tuesday was positive about the India story. However, it projected the economy to grow at 6.5% in 2023-24. The survey also said that a strong domestic economy will provide some immunity from the global slowdown. So, what does the economic survey tell us about growth? Bhaswar Kumar answers this in our report.
The survey projects the economic growth rate to be 6.5% for the next financial year. As of now, the United States economy looks set to avoid a full-fledged formal recession. And therefore, this January already we have seen crude oil prices and industrial metal prices higher than they were at the end of December. From the Indian standpoint, a moderate to somewhat significant global economic slowdown will be, on balance, a better outcome because it would lead to lower commodity prices and a cessation of interest rate tightening in the developed world, weaker dollar, etc. Therefore, in order to make sure that we fully accommodate the downside risks, the band has been kept at 6 to 6.8 and the baseline number at 6.5%. This number is very much in line with what international organizations have predicted, including what the IMF said this morning.
That was Chief Economic Advisor V. Anantha Nageswaran, who has authored the Economic Survey 2022-23 along with his team. Released on 31st January, the survey asserts that India's recovery from the COVID-19 pandemic has been relatively quick, and it projects that India will grow at a baseline rate of 6.5% and within a range of 6 to 6.8% in FY24. However, it cautions that the global macroeconomic slowdown is the key risk factor to the forecast. Meanwhile, baseline nominal GDP growth is forecast at 11%. The survey says growth in FY24 will be supported by solid domestic demand and a pickup in capital investment. It indicates that incipient signs of a new private sector capital formation cycle are visible thanks to healthy financials. And the government has raised capital expenditure substantially, compensating for the private sector's caution. However, it warns that while commodity prices have retreated from record highs, they are still above pre-Ukraine conflict levels. And coupled with that, strong domestic demand will raise India's total import bill and have an unfavorable impact on the current account balance. The survey also says that borrowing costs may stay higher for longer, as entrenched inflation may prolong the tightening cycle. Thus, it says that the global economy may be characterized by low growth in FY24. So, will the downside risks overwhelm the upside potential, or will it be the other way around?
I would say that the risks are to the downside, and one needs to remain vigilant at this juncture. There are many positives that India has. The corporate balance sheets are healthy. The banks are in a position to lubricate the economy. Digitalization is helping improve efficiencies. All those things are there. But I think from a short-term perspective, I think the growth risks are high to the forecast of 6.5%, and it's a little optimistic compared to our estimate of 6%. And multilaterals are also closer to 6% right now.
There are fewer downside risks which would materialize, and I think the number which they've given of 6 to 6.8% is almost similar to what we in Bank of Baroda have of 6 to 6.5%. And in the absence of another COVID round or any kind of exacerbation of the crisis in Ukraine, I do not think we have any major downside risk to this number of 6.5% which we're talking of. Given the fact that we know that even the recession in the West is not going to be as severe as what one had anticipated. So whatever external factors are there which could be having an impact on domestic growth, that would tend to be tempered to a large extent.
The RBI has projected CPI inflation for Q1 FY24 at 5% and for Q2 FY24 at 5.4%. Against this backdrop, the survey says that upside risks to India's projected benign rates may outweigh the downside. It still says that the inflation challenge in FY24 will be a lot less stiff than it was in FY23. In conclusion, it expects both the monetary and fiscal authorities to be as proactive and vigilant as they were in FY23. So, how do experts read this expectation?
The drivers of inflation are not fully dead as yet, so to say. So I think you'll need to be cautious on the inflation front and possibly the imported inflation part. Although I expect the rate cycle to end after another rate hike in the month of February. From a fiscal perspective, I think there is no doubt about it. I think the survey is batting for fiscal consolidation in a way. I think it is talking about reducing the deficit and the positive spillover benefits that it has for interest rates and other things in the economy. So I would say that the fiscal consolidation and monetary vigilance, I think both these are the two signals that I get from the survey.
Inflation is going to be moving in a downward direction. That is a given fact from the economic survey. On the other hand, it also talks in terms of monetary caution in the sense that it sort of signals saying that as far as monetary policy is concerned, let's not really expect that the RBI is going to start lowering the interest rates immediately. It will be a very cautious kind of an approach which will be followed by the RBI, even though inflation is going down, and this sort of gels with what the RBI has also maintained. As long as RBI retains the repo rate, let's assume it goes up to 6.5% and remains at 6.5% for a prolonged period of time, the cost of borrowing will also continue to remain where it is right now. So while it may not be going up further, but the possibility of lending rates coming down will not be in a hurry.
And finally, what are the survey's implications for the union budget that will be presented on the 1st of February?
I think one signal on the fiscal consolidation will be adhered to, and I think my sense is government will facilitate further private investments, and also I think keep the pedal on infrastructure investments. The growth is slowing, so the tax revenues will not be that buoyant. So they'll have to reduce revenue spending and increase and shift it towards capital spending. Now, this was the strategy last year also, but this strategy did not succeed because the subsidy bill actually went up higher than what was expected. Now, in the coming year, I think the chances of global price hikes of the kind that we saw last year are less. So I would say that the support to expenditure restructuring from the external environment will be much higher this year than it was last year.
See, what I think the only takeaway for the budget would actually be the GDP growth number. So here it has been projected in nominal terms to grow at 11%. There were quite a few economists as well as analysts who felt that given the fact that inflation has come down, the nominal GDP growth for next year would be less than 10%. So our sense is that it would be in the region of 11 to 12%. The economic survey is talking of 11%. And I think it would definitely be above 10%, but that would give that much of elbow room to the government when it's deciding on the fiscal deficit ratio.
The survey has painted a conservative growth outlook while emphasizing that India's economic fundamentals remain strong. Now, all the attention will shift to the union budget to see whether it will be able to secure the country's growth against the downside risks highlighted by the survey, while at the same time making the most of the upside potential highlighted by it.
But the good projections of the economic survey failed to cheer up the Indian financial markets as the benchmark indices ended flat on Tuesday. All eyes were on Adani Group's FPO, which was fully subscribed on Tuesday thanks to the non-institutional investors. But it seems trouble for the conglomerate is far from over. The rout, which started with the release of a scathing report by Hindenburg Research last week, has shaved off 16% of its market value. According to reports, Banks are now wary of giving fresh loans to the company. So, what lessons does it offer to regulators? What can they do to avoid a recurrence of such a fiasco? Bhaswar Kumar's report has the answer.
Adani Enterprise follow-on public offering was fully subscribed on Tuesday. It was a dramatic turnaround as the 20,000 crore rupee offer had received just 3% subscription just a day before. The Adani FPO, which would otherwise have been a lucrative bet for most investors, struggled to attract subscribers until the last day because of a damning report released by a US-based research firm on January 25th. A host of serious allegations made against the Indian conglomerate by Hindenburg Research, a firm led by Nathan Anderson, led to a steep fall in the market valuation of the group's listed companies. After the release of the Hindenburg report, the Adani Group shares slid on the bourses, falling in the range of 13% to 46% over the past week. By comparison, the NSE and BSE benchmark indices declined a little over 2% each. In the pecking order of the world's richest, 60-year-old business tycoon Gautam Adani was relegated to the 7th spot from 3rd just a week ago. While the FPO's success may give some breather to the group, it may not dispel the concerns over corporate governance practices at the group. Hindenburg Research alleged that the conglomerate had engaged in what it called a brazen stock manipulation and accounting fraud scheme. It also accused the group of improper use of offshore tax havens and raised a red flag about its high debt. The investment research firm also said it had taken short positions in the group's stocks. The firm also accused members of the Adani family of creating and managing what it described as a vast labyrinth of offshore shell entities in tax havens like Mauritius, Cyprus, and the UAE. The report claimed that some of these entities were used for market manipulation. The report mentioned cold import over-invoicing investigation of the Directorate of Revenue Intelligence, which involved other Indian firms and public sector units. Further, it said the group was previously investigated by 4 government agencies. Ultimately, Hindenburg said that even if investors were to ignore its investigation and take the Adani Group's financials at face value, its 7 listed companies had an 85% downside purely on a fundamental basis because of their very high valuations. In its immediate reaction, the Adani Group dismissed the report, describing it as a malicious combination of selective misinformation and stale, baseless, and discredited allegations, which has been tested and rejected by India's highest courts. Adani Group's chief financial officer issued a statement saying the timing of the Hindenburg report showed that its principal objective was to damage Adani Enterprises FPO. The American short seller's allegations had come just 2 days before the launch of the mega FPO, which kicked off for public subscription on the 27th of January. The group also described Hindenburg's conduct as securities fraud. Ultimately, this appears to be turning into a battle of narratives, and India's attractiveness as an investment destination could end up suffering as it escalates. So, what can the regulators do in such a situation, especially to ensure that future allegations and conflicts of such a nature involving Indian companies don't emerge?
The regulator, SEBI or MCA for that matter, needs to bolster its capacity and capability to investigate offshore matters. And two is they need to work towards quick, I would say, closure of any complaints.
So has SEBI stepped up its effort?
For at least the past 2 decades, Indian companies and offshore investment vehicles have been the subject of controversy in that sense of because of the Mauritius, Cayman Islands route. And this is not just in India, globally also. And SEBI has stepped up its efforts in KYC, finding the ultimate beneficial owner of many of these shell companies. So I think it's always a work in progress, not just for SEBI, for regulators globally also. And I think SEBI has to collaborate with other regulatory agencies to just continue its efforts in this front.
Will these allegations affect investors' sentiment in any way?
I don't think any complaint or report can erode the confidence in India of investors or the securities market in general, as RBI, SEBI, and Ministry of Finance tightly regulates the Indian securities market. Ultimately, complaints or the source of information could come from anywhere, whether within India or from the outbound jurisdictions. It is the substance of these complaints that matters. Both of these regulators, RBI and SEBI, are entitled to summon Hindenburg researchers to provide the basis of their complaint so that they can look into the entire issue from a governance as well as the respective banking and the securities law related issues.
Is there any change in the regulatory framework required, or is it just about better enforcement of existing rules?
SEBI, of course, has very wide powers, and more often than not, it has exercised these powers against market participants and listed companies. Certainly, for transparency in fund flow from promoter and promoter related entities to other people, SEBI may tap into forensic audit if required. But whether it is a prima facie case for forensic audit or not, merely because some report has come, one will have to see the nature of allegations along with the evidence which has been provided. SEBI can definitely ask for disclosures. It can even check for secretarial auditor's report. It can call for the views of independent directors as well as the audit committee. As far as the secondary market transactions on the stock exchange are concerned, BSE and NSE both can analyze the trades if the allegations are relating to the stock play. Therefore, I don't think that there is a change in regulatory framework that is needed, but definitely if within timeline an investigation is completed or a faster investigation happens, that will allay some of these concerns which have been raised.
Regulators could clear the air on the controversy and allay the concerns of investors. It will not just instill some confidence in them, but will also improve the image of the country as an attractive investment destination.
The union budget is being presented at a time when the global economy is slowing. So will the government bite the bullet and stick to fiscal prudence? Which sectors are likely to be accorded priority? Puneet Wadhwa spoke to leading market experts and economists to understand what they expect from the finance minister this time.
The Union Budget for fiscal year 2023-24 will be unveiled on February 1st. It comes at a time when the global economy, including India, is facing multiple challenges in the form of recession fears and slowing economic growth. While this may put a strain on government coffers in the months ahead, analysts are not ruling out possibilities of populist announcements. This is because the budget will be the last full one before the country heads into a general election in calendar year 2024. Moreover, 2023 is also dotted with several state elections. Madan Sabnawis of Bank of Baroda, for instance, expects the government to rationalize subsidies which can pay for the additional spending that the government may do in the election year.
See, when the finance minister presents the budget for this year, I think the major conundrum is that while we move along the fiscal consolidation path and probably aim for a fiscal deficit ratio of 5.75 to 6%, the challenge really is as to how exactly are they going to garner revenue, given the fact that GDP growth is going to be slower next year, both in real terms as well as in terms of inflation, which means that the tax buoyancy, which did help us in 22-23, may not be to the same extent in 23-24. So I think it'll be a more case of how you manage your expenditure. There are certain expenditures like subsidies which have to be managed. A certain part has already been done in terms of the food subsidy. Maybe the fertilizer subsidy will require fewer outlays if it turns out to be a normal year, which is a reasonable assumption to make. And therefore, the focus will be more in terms of seeing within these kind of constraints which are there, whether it's possible to probably get in a little more capex, maybe around 10-15% higher, so that you're able to balance all the requirements or all the demands which are there from different sections. This could also be combined with maybe a little more PLI for the SMEs of some more sectors. And on the revenue side, of course, the critical part will be what kind of a number is taken for disinvestment, given the fact that we haven't really been very successful in terms of meeting the targets. So we'll have to have a more practical kind of a number, maybe in the region of around 40 to 50,000 crores, nothing more than that. Because taking tough calls on certain enterprises may also be a challenge in this particular year, again keeping the elections in mind.
Analyst at HSBC meanwhile believes markets will likely rate the budget on transparent and credible fiscal math, improved tax regime, continued capex thrust, support to states, and addressing liquidity and bond market concerns. Those at Goldman Sachs, too, do not expect significant reforms in the upcoming budget in the backdrop of the several state elections in 2023 and the general elections in 2024. The brokerage says it will watch out for a commitment to fiscal consolidation, capex spend, manufacturing SOPs, subsidies and welfare supply of government bonds that the market can absorb. Other leading brokerages, too, share a similar view. Analysts at Nomura suggest that the focus in the upcoming budget could include support for consumption, strong focus on manufacturing, especially MSMEs, higher infra, agri and rural spend, and asset monetization. Let's go to Narendra Solanki of Anand Rathi to know his brokerage's expectations.
Also remember, this is the last budget before the general elections, so budget undertone may be populist and may be more focused on rural aspects, especially reviving the rural demand, rural consumption could be the key driver for the government. Also, coming to the sectors which could see some positive announcements are auto, especially in EV segment, we can see some announcement. In manufacturing space, steel and aluminium, we may see some custom duty positive announcements. Then in infrastructure, we can see some positive announcement as government focus would be to heavily up the spending on infrastructure. Then we can see some tax rate restructuring in the budget announcement, which could be better for salaried class people. Then overall, the budget could be focused on growth, fiscal consolidation also could be the important area, as markets would be watching how the government actually balances its fiscal deficit along with improving the spending.
Over the next few days, the markets are likely to remain choppy as they digest the budget proposals and their impact on the economy and India Inc. Moreover, investors will assess the US Fed's policy statement due later tonight.
This budget will give an account of where the money is expected to come from and where the government plans to spend it. But the annual financial statement, as the budget is called, is also full of complex terms. Raghav Agrawal helps us understand them better in our next story.
The budget is made up of two main components, income and expenditure. In India, the expenditure is usually higher than the revenue. The difference between the government's expenditure and its revenue is called the fiscal deficit. In simple terms, it is the money that the government spends in excess of its income. This deficit is calculated as a percentage of India's GDP. The deficit rises when the government's expenditure rises or the income falls. On the other hand, it shrinks when the income rises or the expenditure falls. The income and expenditure of the government are of two types, capital and revenue. Capital transactions are long-term and lead to a change in the assets and liabilities of the government, like buying new land or vehicles. Revenue transactions, on the other hand, are recurring in nature, like pensions and salaries. When the government spends money on acquiring long-term assets that will generate revenues for years, it is called capital expenditure. This includes money spent on building roads, bridges, and factories, among other things. While we have talked about capital transactions, there are some transactions that do not lead to a change in the assets and are temporary in nature. These are called revenue transactions. Some incomes like taxes and rent from property are called revenue receipts. On the other hand, expenses like interest payments, salaries and pensions are called revenue expenditures. The budget that lists these revenue receipts and the expenditure met using those receipts is called the revenue budget. It simply tells us where the government is getting money to meet short-term expenses. The budget also allocates money separately for subsidies. A subsidy is a benefit given to an individual, business, institution, or particular sector. These are given to reduce the monetary burden and in the interest of the public. Subsidies can be direct in the form of cash payments or indirect in the form of tax breaks. The subsidies aim to reduce the price of a particular product in the market, or as in the case of the fertilizer subsidy, to compensate producers for selling their products at a price lower than market prices. Even the production-linked incentive scheme is a form of subsidy. Sometimes, the money kept aside by the government in the budget may be different from the amount it spends on a sector in the year. The numbers it announces in the budget are called budget estimates. Budget estimates represent the government's wishes and ambitions. Revised estimates show how the expenditure is likely to pan out. The two estimates may vary, but not hugely.
I will achieve, I will fly high. I am the SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hope that helps you read the budget better. Don't forget to watch the next episode of the morning show. We have a special budget show for you. That's all for today. For comprehensive budget coverage, please log on to business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.